to Seller Sessions Wednesday afternoon, 4 p.m. UK time. Tim Jordan is back in the hot seat. Hey, Tim, how you doing?
I'm good. How are you?
Yeah, good. So do you want to let everyone know a little bit about yourself and I'll share to the groups?
Yeah, and actually, I'm making some updates. I'll even fill you in, Danny. But
Go on.
yeah, I've been in e-commerce for a number of years here. Built and sold some brands. Still have some stuff that a little bit of stuff that I sell online.
Yeah.
I have done a lot of content with different people, collaborations done myself. Partnered with Norm Farrar and Private Label Legion. I'm the host of the AMPM podcast. And for the past couple of years, I've been working as a strategic advisor to some of the service-based companies in the space.
Mhm.
One of which was Sellers Funding, who I then took a actual employment role as their chief growth officer. And Danny, I'll fill you in now too. I'm actually
Go on.
stepping out of that role. I put a time limit on that, and the company's growing so fast and bringing on a lot more executives that it makes more sense for me to step back
Yeah.
to a consultancy role with them and partner with them on some stuff. So
Great.
as of July 1st, that'll be in action. So now
Yeah.
I'm just back to trying to just help as many people as I can. Got my fingers in a lot of stuff and trying to learn from this crazy world.
Excellent. So, which is good because today we're going to be talking about funding, and it's not just going to come from one angle. You've got some background on various different areas of funding. This conversation came up because there's good friends of mine who are sellers, and I spoke to you about it. They're looking at going the route of raising more funding now in order to sell through on the current pipeline of products and then go for exit, which, as I said this in the show notes earlier on, it's like on Amazon, one day you're the cock of the walk, but the next day you could be a feather duster. So there's always that risk. So it's taking the short money off the table and taking of a less risk approach, but there's a lot of very non-risk averse players in the space who will just go for it. They trust themselves and they will go for it. But as I said, we know that there's no guarantees. You could have 6 hits in a row and then 6 flops in a row, but at the end of the day, you've got to back yourself as an entrepreneur. So where do you want to start with this? What have we got?
Man, I will start off by saying, a couple of years ago, I knew very little about financing. I knew very little about mergers and acquisitions, about the way debt works, even the way that money transfers and global banking system works. In the past 2 years, I've learned a lot. So I made some notes specifically about funding. And these notes are kind of based off of the questions that people typically ask, like, hey, Tim, can you dummy this down and explain this? Because we're a 7-figure brand, but we don't come from the world of like understanding this and learning this. Nobody teaches us this stuff as we're trying to bootstrap this stuff in our garage, right? So I've got a list of stuff, and I think that the first thing we talk about is types of funding, right? For e-commerce sellers specifically. There's a lot, but there's really 3 primary ones that I was going to break down to. And this is for whether you're getting business started or trying to scale up. The first type is angel investing. The second type is family and friends. And the third type is VC funding. And this is equity-based funding, right? We're not talking about borrowing right now. We're talking about just getting money to start. So I think most of us understand what angel investing is. Angel investing is usually it's usually small amounts. It's usually like pre-seed, like very early, like we're trying to get started. It can be very, very small amounts. And angel investors are typically going to try to invest in a lot of different companies and hope that 1 or 2 make it big, right? We see it a lot in the software space where people go into these software incubators and they'll, invest $5,000 in 20 different companies and hopefully one of them turns into the next Uber or the next, Amazon. We're seeing that in e-commerce spaces too, because as e-commerce brands continue to grow, and especially these like unnamed brands are starting to become recognized as big players in the space. There are some of these angel investment aggregators even that are allowing e-commerce brands to come on and say, hey, I have this great product. I have this great brand. We're seeing it a lot with influencers. I'm a NFL athlete. Does anybody want to pitch in, help me, get a brand of t-shirts or, face masks or whatever it is started? A kind of a subset of angel investing, but people don't really see it as angel investing, see it as something different, is just family and friends, right? And family and friends is a very interesting type of acquiring funds.
Never do it. But go on.
Yeah. I've always said that too, but someone made a good point to me the other day I want to share. Thank you, Paulina. So family and friends is something I've always been scared of, taking money from them, because most businesses fail. That's the truth of it. And most of my businesses have failed, either or I broke even. I learned a lot. It was worth doing. I'd do it again, but monetarily, they didn't have a return, right?
Mm.
And if you take money from an aunt or an uncle or your parents or a sibling, right? If it fails, it's like a lot of pressure. It's a lot of stress. Now, someone came to me the other day and I was talking about this. I said, but Tim, what if it succeeds? Oh, what do you mean? I said, what if it succeeds and you didn't allow your family or friends to invest?
Mm.
I thought, now that's a whole different scenario, because what if, my family and friends come and say, hey, we want to invest in this business. I say no, and then it turns out to be massive. They're
Yeah.
going to feel
Okay.
like I left them out. So it's
What
like,
about
damn
if I
if
give you
do,
some
damn if don't.
context then? Okay, let me give you some context. What you don't do is you don't take money off family and friends that don't have that money to burn, right? Their life savings, etc., or they're actually business owners themselves and that they get it. If you can verify that, that's a different story. It's different when, Aunt Sal effectively has got some money saved up. She's never done anything. She goes, hello, son, I give you the money. Don't worry, it's all going to be good, and then you lose her money. Then she loses her shit because she has no understanding of business. So
Yep.
suppose that's different from the friends and family side of things. It has to be rock solid, and you have to understand, do they understand about business, and can they set fire to that cash?
And I think there's a difference of whether they approach you or you approach them. Don't go to your friends and family, say, hey, man, I got a business idea. Do you want to pitch? Just don't do it. Like blanket statement, absolutely do not do it. But if they come to you and say, hey, Tim, I see you're getting involved in this stuff. Is there an opportunity for me to maybe get in and throw some money? And like Danny said, I would tell them, hey, this may turn out to be nothing. Like, make sure this is disposable money for you. Don't hate me if it blows up and nothing ever comes of it. But if you don't at least maybe give them that option, I think there is an argument to be made that they might be more pissed off at you if it does go big or does go well and you didn't let them have a piece of it.
Yeah, I'll
right?
tell you what, I'd rather have a Christmas dinner where we have it right off with a business and then goes, all right, you didn't chip in, but here's an envelope of cash. Thank you. And here's a little treat for you. Versus we just done all your life savings and we have to spend Christmas dinner each year with you. That is going to be a really tough one, I think. So there is a difference,
Yep. And the third primary type of equity fund acquisition or funding really is traditional venture capital funding, right? Now, this doesn't apply to most e-commerce brands. It doesn't, because most of us that are getting this e-commerce thing is side hustlers, solopreneurs, a lot of people just by accident. We don't understand how that system works. And honestly, we don't know how to go out and raise money. And VCs, until recently, have been a little bit, risk adverse to partnering in brands that don't have some sort of brand presence already, right? So I mention it because it's important. And I mention it also because you're starting to see the VC world collide with this solopreneur startup world of e-commerce because of the acquisitions that are happening, the M&As that are happening. So you're starting to see VCs get involved in like these aggregators who are then buying brands. So it's closely related. It's probably not a viable option for most of us that are listening, but I did want to mention it. So equity-based funding, especially for startups, angel investing, family, friends, or VC funding, right? Those are the primary areas of doing it outside of just bootstrapping it yourself. Like, this is outside funding. When we actually look at the types of growth funding, right? This is like, hey, we're rocking and rolling, but we need some capital. All right. Then we start to look at debt funding, what we call debt funding. So equity funding and debt funding. Debt funding is acquiring the use of someone else's cash essentially to build your business. There are a million ways to borrow money. There are. But in the e-commerce landscape, I'm going to talk specifically about the three primary types of debt funding. I'm not talking about equity funding. I'm not talking about some of these weird crossover, sometimes even predatory stuff. We'll talk about that in a second. But the three primarily legit types are revenue advances, term loans, and what I call flex loans or flex funding. They legally can't even be called loans. And it took me a long time to learn this, that there's so many legal qualifications, there's so many legal ramifications, there's so many licenses you have to have in different countries, even with sellers funding, right? Like, they're legally licensed to provide loans in some countries. In some countries, they're legally licensed to provide a revenue advance, but not a loan, right? So that's why there's some differences. Let me explain what these are. And a lot of you that have tried to come up with funding have seen these. A traditional term loan is what you think it is. It's an amortized loan. You are going to receive a certain amount of money and you're going to pay a certain amount of interest over a certain amount of time, right? In the e-commerce, especially working capital for inventory space, that can stretch anywhere from 3 to 12 months, right? And that's kind of typical to the timeline that we see e-commerce sellers needing specifically for working capital, all right? If we're investing in our business, building a warehouse and buying forklifts, it might go longer, but typically it's 3 to 12 months. The way that works is you receive a loan, you have to, provide all the documentation, you have to go through credit checks, make sure you're credit worthy. And then that principal amount that you've borrowed starts accruing interest. Okay. Just like a house loan, just like a car loan. Every day or every 2 weeks or every month, whatever the term sheet says, it is accruing interest that you pay. So as you pay down this, let's say 12-month loan, you're paying back a combination of principal and interest, right? Most of the loans, the term loans out there, will allow you to prepay early without penalty. And we see this a lot in Q4. People will take a 12-month loan in October or September to buy inventory for Q4. And then if they have just a crushing Q4 and just smoke it and they have tons of cash, they'll go ahead and pay that back in January or early February with the excess cash that they have, just to stop accruing extra interest, right? So you understand that it's saving you money. I think we all know what term loans what term loans are. The second most frequent is what's called a revenue advance. And a revenue advance is legally a completely different type of funding option. It is easier to get, especially when you're in a non-typical situation, like maybe you're a German citizen, but you have a U.S. bank account and a U.S. business entity selling in the U.S., right? A U.S. bank typically won't lend to you in that situation unless you have just mountains of history, tax returns and all that stuff. It's just kind of easier legally to get these revenue advances across the line. And what these are is the way I kind of describe it is you're purchasing a receivable, right? So what I'm saying is, all right, Danny, I'm going to give you over 6 months. I'm going to give you $50,000, and you're going to pay that back over 6 months. Mm-hmm. And I'm going to charge you a fee for that up front. Okay. So I'm advancing you the money that you should be receiving in revenue, and I'm going to charge you a flat fee up front. So you see this all the time. You see Payoneer doing it. You see Clearbank and OnDeck, and Kabbage was really big in this. Even the original Amazon loans were like this. Say borrow $50,000 for 6 months and it'll cost you 6%. Okay. Well, that's not a 6% interest rate. It's a 6% fee. Very different between term loans and revenue advances. 6% fee. So what they do is they say, all right, and I'm going to pull my calculator up here to make sure I get this right. They're going to say, all right, Danny, you need $50,000 at 6, and we're going to give it to you at 6 for 6 months at 6%. So $50,000 times 0.06, 6%. The fee is going to be $3,000. Okay, so $3,000. So they're going to charge you $3,000 to give you $50,000 over 6 months. And they charge that up front. So typically what they do is they make you sign a contract saying that over 6 months, you're going to pay back $50,000, right? $50,000 divided by 6.
Did they give you 50,000, but then deduct 3 for 47?
Yeah. Right. So what they'll say is you owe us basically $8,300 for 6 months, which comes up to $50,000.
Yeah.
We're going to charge you $3,000. So instead of paying you $50,000, we're going to give you $47,000. So they disperse $47,000. You owe $50,000 over 6 months, or sometimes it's even biweekly. They take money out, right? This is an interesting option because people are frequently able to get revenue advances that can't get term loans because of geographical things or legal things or whatever. And for people that aren't really, really good with finance, it's easy to understand. Right? I know my cost of capital is $3,000. This will cost me $3,000. It's very cut and dry. It's very, very easy to understand. Since the fee is put up front, there is no savings if you pay back early, right? So you don't have the option of saving money like you do a term loan if you pay it back early. But it also means that you're not worried about paying it back early. Very, very, very few people are going to pay back.
Or in some cases, the penalty to paying too much off too early as well. Sometimes they include penalties. Yeah.
Yep. Sometimes the term loans do. Now, if you do have a revenue advance and you've paid for the fees up front and you've got another 6 months left of your 12-month term and you've already prepaid that fee, but you have a lot of cash, sometimes you can go to them and say, hey, I know I've already prepaid my fee. You've already gotten your revenue off of this, but I've got your money for 6 months. If I go ahead and prepay this back, will you give me a rebate? And sometimes they will do that because they have cost of capital too through credit facilities, which we'll talk about in a second. So that's kind of the short version of revenue advances. If any of you have questions, post it in the comments because I know I'm covering some deep stuff and I'm going to try to cover a lot of ground today. But ask any question. But those are revenue advances. The third primary type of debt funding, especially for working capital, is I don't even know what the official name is, but let's call it flex loans. And you see this with several providers. I know this is what Payoneer is offering at some point because legally they couldn't actually give a loan. And what it is the marketing will come out and say, hey, we will advance you or we will front you. They can't say loan. $50,000. You pay it back over 6 months and you pay us back a percentage of your gross revenue until you've paid us back X amount, right? So let's say $50,000. We're also going to charge you 6%. It's usually more expensive, right? 6%. So now you're going to be paying us back $56,000, and we're going to take 15% of your gross revenue until that gets paid back. It sounds interesting in marketing because they say, hey, if you have a slow month, you pay us less. If you have a big month, you pay us back more. That's a little bit scary though, because they take into consideration potential slow months. So since this could stretch out longer than they anticipated, they are going to charge you more upfront. So the fee is usually more, it's a little bit more expensive. If you make more money in sales, so I don't call it making money. If you bring in more money in sales, you have more revenue, you pay them more, which is also a little bit scary in my opinion, because those big months you should have for float cash. Like you want to be able to do other stuff with. So for people that are just getting brand new started and you don't have another option, the flex loans are usually the easiest to get. There's less red tape. It's a little bit more risky because it's not like a fixed amount every month that you know that you can check. And usually there's like what I call a cliff. They say, hey, this is flex, except for if X happens. And if X happens, which means your revenue stops, or you don't hit a certain low revenue number after like 9 months, then we switch back to a traditional payment schedule and you have to pay us whether you like it or not, right? So those are flex loans. So revenue advances, term loans, and flex loans are the three primary types of working capital acquisition for e-commerce sellers. Any questions on that before I move on?
No questions in the comments as of yet, but maybe there's a little bit of delay and they may join.
And if you have anything you want me to clarify, Danny, or you think I'm missing out, just
now it's really let's just say you pointing out where to place the best place to get loans, and let's talk about the scenario. So let's just say that you've capitalized your own business, but then you have a pipeline of products that you could launch and you could take some of the cash on hand. But instead you're thinking, okay, I want to extend the value in this business before I sell it. So the risk is I launch these products and I think I'm good at what I do. Do I then take the money from a third party as a debt rather than an equity loan and then just go for it? And how should I structure that?
Whew, that's a big question, because now we're talking about acquisition.
Well, no, because the final stage is the acquisition is to create more value in the business before you sell it, right? Well, so let's just say you're doing 2 or 3 million, but then you raise some money to launch 10, 15 products, and let's round the number up and take that up to 8 million.
Now, are you talking about raising money or borrowing money?
Well, borrowing the money, yeah, I'm using the wrong term. Sorry, raising money is obviously different. So borrowing a debt-based money, to capitalize those products prior to doing the sale.
So that question is above my pay grade, so to speak. Like that's something that really, really good business folks besides myself have an opinion on, and I'll share that opinion. And I know that recently you had Chris Schifferling on, right? True investment banker. And when brands come to him and say, hey, I think I'm ready to sell my business, a lot of times he says, no, you're a year out. What you need to do is go get capital and build inventory, build your sales. So people that are smarter than me always say, man, try to build this business up. Now, don't take crazy risks, but most of us, it's fairly easy to look and say, hey, this is selling. If I had more inventory, could I sell more? Right? Like I have a list in this niche. Does it make more sense to load another SKU into here? Right?
Yeah.
Now, when I was saying there's a little bit of a complexity with acquisition, here's what I mean. And this is still down my list, but I'll jump forward a little bit. You take on a responsibility and you complicate your business operations structure, even in legal obligations when you take on debt, right?
Yeah.
And a lot of times the timing isn't perfect. The timing isn't, I paid off this loan, now I'm ready to sell. It's not clear cut like that, because a lot of times even huge businesses, Lego, they borrow money all the time. Apple borrows money all the time. So you will probably want to have some sort of debt at the same time you want to sell your business, right? Because maybe you just reinvested for Q4, you're ready to sell in March, but you've got this revenue advance or term loan that's not due yet. It complicates things. So you do need to consider the ramifications of what type of debt you're receiving and determine, do I need to have this paid off to make an acquisition, or will I be able to go through an acquisition while holding this debt? And I can talk about that in a second. Let me tell you where, going back to the three types, let me tell you where most of us see that, because I think that some people are going to say, well, give me an example of that. If we looked at term loans, these are traditional like bank lines of credits, okay, which most of us can't get in the e-commerce business. It just doesn't work out. Right.
Yeah.
But where we see a lot of the revenue advances and where we see a lot, well, let's just say working capital in general, are from companies that recognize, or from solutions that recognize our growth potential, and are usually doing that based on data feeds. Okay. So a great example is Amazon loans. And even now that they've partnered with Goldman Sachs, which has turned into kind of a dumpster fire a little bit, but they're going based on, they're offering money based on just revenue. They see the sales, they see the sales growth, they see different analytics that they have, even sellers funding. That's what they do, is they're not looking at tax returns from 3 years ago. They're plugging into APIs and tracking data. So like when Amazon offers you a loan, it's basically based on sales. They're not asking you for profit and loss statements. They don't care about that stuff. They're just talking about revenue. We also see that now with Shopify Capital, right? They're just tracking your sales. We see that with PayPal. PayPal is tracking your money just transferring through, and they're offering you loans. Now Stripe is doing that. If I have a Shopify store and I'm using Stripe to make my payments, right, or to receive my payments, I might be getting offers from Shopify and from Stripe, because they both see the transactional volume. They can say, hey, based on your volume of $7,000 a month, you're eligible for $10,000 over 6 months, right? Here's the problem. Because they're using the qualifications of data and revenue to offer this financing, they have to market it as what's the word I'm looking for? Inexpensive. They have to market it in a way that looks really, really beneficial for us. And because most of these are actually revenue advances, they are muddying the waters with marketing, because they're coming and saying, hey, come get a 12-month or come get a 6-month loan for 4%. Well, what people don't realize is that's not the same as a term loan for 6% interest. It's much more expensive. If you amortize that out, it gets crazy. There are people out there that were taking, and I was one of them, that were taking Amazon loans for 6%. But when you amortize that out and you calculate not as a revenue advance, but actually amortize that interest, it might be 20%, 18%. It's much more expensive. And especially some of these revenue advances and flex loans that we're seeing, especially through like Shopify, Stripe, PayPal, even Payoneer, we're seeing stuff over 35% interest rates, the equivalent of, right? So they're easy to get. They're catering to an industry and verticals that we're in that maybe banks aren't really familiar with and comfortable with. And sometimes you got to use it. Sometimes it's all you can have, and you just got to do it to build. And there is so much value, I think, in using someone else's money to scale your business. Especially when we're looking at a potential to sell our business. But we just need to understand what that means, right?
Yeah.
Another thing that a lot of people don't understand is that people that loan you money are not loaning you their money. Okay.
They're loaning the money they're borrowing.
They're borrowing money too. And those are called credit facilities.
Yeah.
So for example, sellers funding, right? And just because I've worked with them for so long and they've taught me so much, I'm using them as an example. But sellers funding has basically, I'm oversimplifying this, but they have they have many more than this, but let's say they have 2 bank accounts. One bank account is where they operate the business out of. This is staff, this is marketing, this is infrastructure, this is IT, this is the dev side. And then they have this pool of money that's available to them, which is basically a credit limit from another facility, right? And that facility has a cost of capital that's charged to sellers funding. So if sellers funding says, hey, I'm going to give you a term loan for 12 months at 12%, it doesn't mean that sellers funding is getting 12%. They're having to pay usually more than 50% of that back to the credit facility, right? And this is important to understand because it helps us understand why different types of capital cost different amounts. Because here's what I see all the time. People come and say, man, Shopify, whatever Stripe, they're charging 30% if I break that out to an APR interest rate. Sellers funding is offering, these loans at, term loans at 13%, right? 12%. But I can go to my bank and I can get a credit line for 7% or 8%. The reason for that is banks, actual banks, are able to borrow money from governments. And right now,
Which
the
is at a
U.S.
lower
government,
interest rate. Yeah.
the government is almost free. So a bank that borrows money as a credit facility from the U.S. government is almost free. So if they're charging 7%, they're probably going to make themselves the same amount that Sellers Funding might charge at 12% with the money they have to pay to their credit facilities, right?
Yeah.
Now, the thing is, the U.S. government will loan banks money at 6 or 7% maybe, or for free. I mean, for free for the banks to charge 6% because it's very low risk.
Yeah.
And that makes it very difficult for e-commerce sellers to access that type of capital, because to be very low risk, they have to go through the old school models of tax returns and longevity and, very traditional businesses, which we don't. So even when you can get money through a credit limit through a bank line of credit, the amount is usually much smaller. I have people all the time that came to Sellers Funding and said, hey, we need a loan. Say, okay, well, here's your offer, 12, 13%, whatever it is. Well, my bank has offered me 8%. And I say, how much money do you need for Q4? And they say, $500,000. Say, how much did your bank offer you? And they say, 75,000. Okay. Congratulations. There's the rest of the story, right? It's cheap, but because it's such a low risk model that they allow, it's a very small amount. So I say, go to the bank, take your $75,000 at 7 or 8%. We'll cover the rest. We'll give you the other 430 or 420 or whatever it is, 420,000. So everybody just needs to understand, like in this, I'm just brain dumping as much as I can about funding right now. Remember that the people that are loaning you money are borrowing it from someone else. It's typically not their money. Another side note, since we're talking about acquisition, that also explains a lot of the smoke and mirrors crap that we see with aggregators right now. Okay. And I'm going to step on some toes. All of you aggregators, listen, start telling the truth and quit your skeezy marketing, because this is what happens. Aggregators and other acquirers, a lot of these companies do this, will put out a press release and say, X business just raised $100 million. Well, when you think about that, you're like, dang, $100 million. Like, that's a huge raise. Like, that's a Wall Street level raise. Think, man, that company must be killing it. And they frame it in those press releases to make it look like they're absolutely killing it. Because at $100 million raise, you can do a valuation and say, man, they're a $500 million company now, for example, right? But what they don't tell you is that raise is largely a credit facility, because remember, aggregators are going out and buying other companies. They're building a credit facility to buy other brands. So an aggregator that comes out and says, we just raised $100 million, and people flock to them. I want to work with you. I want to work with you. I want to sell my brands to you. This is great. What they might not be telling you is all they've done is opened up essentially a line of credit with a credit facility for $95 million, but they've raised only $5 million in equity. The $5 million is how they should be valuing their company. So they come out and say, we raised $100 million. Now they raised $5 million, but they've also just essentially opened a credit card for $95 million,
right?
So they can acquire brands, right? Which is like this big misconception of this industry, because everybody thinks, oh, this is great. No, there's a bunch of smoke and mirrors, shady marketing going on. So you guys that put out a press release say we raised $100 million, you better start defining whether it's a credit facility or whether it was equity. And the reason for that is people are getting smart. People are starting to understand this, and people are starting to see through some of that crap. So anyways, there's a thing about credit facilities I just want to touch on, just to help everybody understand the way that lending works.
No worries. So
I'll pause for a second, let you ask any questions, and I'll keep going down my list of
okay. It looks like some of these advanced funding guys want to pay your stock or marketing providers rather than provide actual cash in the bank.
So I don't see that a whole lot. Where you see that are these startups that have deals with these credit facilities that they have to go out and prove themselves. And the credit facilities say, ooh, we'll give you $10 million to disperse, but we want to lower our risk too. And our risk will be easier to swallow if we can pay the suppliers directly. Because what they don't want is they don't want someone to qualify for $1 million. They get $1 million in their bank account and they run off and buy 3 Porsches and move to Puerto Rico and disappear. Right? Which happens. People are doing that in the Amazon loans. They'd get $1 million loan and they'd just be gone. Like, God, you see them in Belize 8 years later with a big beard and a big straw hat, and they're smoking cigars and they're gone. Right? So sometimes the way you see that is through your newer or less legitimate lenders, because they don't have the track record of a low default rate that the credit facilities are going to require to give them more money.
Interesting. Cybe's just come back and said, "Isn't the entire world of e-commerce smoke and mirrors?" Sometimes it feels like that. Sometimes you're just trying to break through to get to the truth. But yeah, there are cases of smoke and mirrors. We just have to look and work our way through the shit and find where the good stuff is. What else is on your list?
So predatory loans. Look, folks, there's some shady stuff coming in, and I'm not going to mention names. And Danny, you and I have talked about this individually.
And I've turned down sponsorship for someone who had an APR of 164%. Yeah. And I had to get Ellis to check it, obviously being a data scientist. I went, does this fucking add up? And he went, Dan, it's rape. Leave it. So
it's awful because it's easy to market, especially when when we as e-commerce sellers don't understand this world. And look, folks, I'm throwing out a lot of terms. I sound like I know what I'm talking about, but I promise this is a recent development. It's only because I've been working in this space of fintech for a couple of years now. If I hadn't, I would be as clueless as the majority of this industry, and I wouldn't know the difference in figuring out how to actually figure out my actual cost of capital. I wouldn't, right? So it's easy for some of these people to become predatory. There are companies out there right now that will offer you a term sheet after you sign an NDA not to sign that term sheet. Or not before they even show you the term sheet, that you won't share the term sheet. That raises up red flags. If you're getting an offer from someone and they make you, before they even send the offer, sign an NDA so you won't share it, that's scary because it means they have something to hide, right? There's a company out there that I'm going to spell out exactly the way their business model worked, because they tried to get me to work with them as an affiliate at one point. And after like 45 minutes of talking to them, I said, wait, I still don't understand your business model. I don't understand how you work. Explain a little more. And I said, I think this is how you work. Tell me if this is right. And they basically were like, yeah, that's basically it. Is this company will come to you and say, hey, we want to help you raise capital, right? We're going to give you capital. And you say, okay, I need $100,000. They say, that's great, but we only match the capital. Okay. We only match capital. So if you want 100,000, you need to raise 50,000 yourself and we'll give you 50,000. Well, that's weird. So, well, we want you to be investing in your business too, right? 50,000. So they will coach you to go to family and friends and beg for $50,000, and then they'll give you $50,000. One of the criteria is that you have to show that you're profitable, right? So you're already profitable. You already have inventory. They're going to match an additional, pool that you're going to throw in at $50,000, give you $50,000, and they'll say, we're going to make it easy. We're partners with you. We get paid when you get paid. If your income goes up, ours goes up. If yours goes down, yours goes down. And we're going to charge you 20% of profits to do this. And you say, 20% of profits isn't bad, because if
20% of the profit. Yeah.
20% of the profit. And you think, well, this isn't terrible, because if I'm having a really good month, I pay them, more. If I'm having a bad month, I pay them less. What they don't tell you is that percentage of profit does not go towards repaying their principal that they gave you.
The principal payment, yeah.
So what they do is they give you $50,000 that you've matched with another $50,000. Now you're on the hook indefinitely to pay them 20% of profits every month until separately and independently you can come up with another $50,000 to pay them back. It's horrible. It's like some of the shadiest, sleaziest crap I've ever seen. And these people are probably listening to this, and they're going to start coming after me. But look, it's bull crap. It's shady. Quit doing this stuff. There are times and places for every type of lender. Just be clear about what you're doing, right? But there's a lot of people that fall prey to this because the truth is, there's not a lot of education about how to manage money. I'm not talking about e-commerce in general. Like, I didn't go to high school and learn how to balance my checkbook. And
exactly. It's not to this day. That's not taught in schools. Even my daughter.
Are the biggest crock ever, because who taught you how to understand a home mortgage? Well, your mortgage company did. Like, the lenders are educating the world on how home mortgages work. It's the biggest bunch of crap ever. But my point is, we have to become more educated on this. And look, when you're looking at potentially taking some risks and growing your business, you've got to go get capital. 99% of people are successful, have taken capital at some point. It's just the way it is. So don't be scared of the solution, but be a little bit timid of the industry, and go back and make sure you're getting reviews. Make sure that you're getting some outside counsel. Make sure if you get a term sheet or an offer from somebody, you go to someone that knows more about you. You say, does this look legit? Just like Danny did. He had to have someone else do the math and go, oh, this is 134% APR, right?
164,
It's all complex. But if it sounds too good to be true, it is, right? And don't borrow money out of desperation, because sometimes we get so desperate, we go and borrow money, we make decisions quickly. So there's my little thing about predatory loans. We've already talked about marketing. The note I had is 4% is not always 4%. You can frame that stuff. I've got 3 more line items that I can hit, and then we'll answer more
Let's do
questions.
it. Yeah.
Collateral. Let's talk about collateral. People always ask about collateral. When I get a loan or a revenue advance or whatever, is there collateral? There usually is, but collateral can be different things. So a bank line of credit will often take a fixed asset, a business, your packaging machinery, whatever asset you have, the bank takes as collateral. But for us that usually don't have any assets like that, we have either inventory, receivables, personal guarantees, or corporate guarantees. Okay.
Never do a
Collateral really
personal
is,
guarantee. Ever do a personal
inventory,
guarantee.
receivables. There is some collateral value in a personal guarantee and corporate guarantee. I'll talk about that in a second. But inventory is collateral. Basically what this means is on paper, the lender will have a lien and the ability to acquire your inventory if you default.
Do you want to quickly explain what a lien is when you put a lien on the business?
Yeah, a lien is like a placeholder, an earmark for ownership on a car. I own my car if I have a loan, but if I default, then
put a
the
lien on it,
ownership
and
will transfer to the bank. So a lien is like a first right of, like we can become owners of this and acquire this if certain things happen, which is a default, right? There's not a lot of e-commerce lenders right now that are allowing inventory as collateral because inventory is so sketchy and hard to find, and it might not be valuable, right? If I'm selling a bunch of bullcrap garlic presses on Amazon, what's really the value? Like even if I default on my loan, they come and they take all of my inventory. One, can they take it out of Amazon? No. Can they go get it from my 3PLs? What if there's 2 containers sitting on the ocean? Can they go get that? No. So it's very hard to get. And then it might not be worth anything anyways. So typically the collateral that people are using, these lenders using, is receivables. This is enforceable. Receivables legally means any money that's coming into you, they can have first right of. Okay. So Amazon receivables is one. Legally, if you default on your loan, they can legally start taking possession of your Amazon payouts, your vendor payouts. If you're selling to brick and mortar stores, they can receive your Stripe funds. They can receive your PayPal funds. And legally, they can do that because it can be court ordered to the platform. So Amazon can be legally obligated to change the disbursement account to the lender's account if it goes that far through the process of collections and all that good stuff. So receivables basically is the strongest non-physically tangible asset collateral that lenders use. And that's usually how most of these e-commerce provider lenders are protecting themselves, is getting a lien on your receivables. Yeah. When it comes to guarantees, look, the truth is lenders got to protect their butts too. And a lot of times the protection is not their own rules. It might be protection and rules that are passed through the credit facilities, because the credit facilities will say, we'll give you $100 million to re-lend, basically to redeploy to these companies, as long as you will also have a type of guarantee. The 2 primary types of guarantees are personal and corporate. Okay. Yeah. Personal guarantees. Did I hear you, Danny, say never sign a personal guarantee?
Never fucking sign a personal guarantee.
So
ever.
You and I would never sign a personal guarantee.
But Muppets out there will. Yeah.
And I'll say there are times.
Unfortunately, I don't mean that in a nasty way. I'm just saying people will do it out of desperation. It's the worst thing to do in the world. It's not worth doing it.
I have signed personal guarantees when I had no other option, when I was just getting started. Because if I had no business track record, if I had no assets, if I had no real receivables.
But was it your home, for instance? Because if your family,
no.
Okay, there's a difference.
It was not a personal guarantee with an asset attached to it, right? So it can be a collateralized personal guarantee, which is, this is my business, it's my LLC, but I'm going to guarantee this loan with my personal signature, my personal responsibility, and tied to my personal home. No, never do that. Never do that. Yeah. But a personal guarantee is like a credit card. If you sign a credit card, even like a business Amex, you're usually signing a personal guarantee saying, if my business collapses, I'll still sign this. And it usually takes like $3 million a year in business revenue and 5 years of history before even American Express will give you a credit card without a personal guarantee. Then there's a corporate guarantee, and corporate guarantees are valuable when your business has some assets, has some substantial sales, some substantial value. And most e-commerce sellers, until they're in this for several years, can't qualify with a corporate guarantee unless they have a lot of revenue coming in. These need to be pretty big sellers. Corporate guarantees also become important when a business is diluted with ownership. So, there's e-commerce businesses, for example, that come to sellers funding all the time. There's even aggregators right now that are using sellers funding for working capital because the rates are so competitive. Well, with that aggregator, it's a very complex thing. They've got a C corp, they've got 2 VCs that have ownership, they've got 6 partners and founders, and they've got some. You're going to make all those people sign personal guarantees because the VCs aren't going to sign personal guarantees, and these other founders that only own 15%, they're not going to sign a personal guarantee for this. So they create corporate guarantees, which is basically saying the corporation as an entity and all of its individual owners and assets and liquidity and receivables will sign the guarantee. So corporate guarantees are a lot safer as individuals, but you have to have some pretty serious revenue and you have to be a more established company before they'll allow that.
Yeah, it's pretty in depth. There's a lot you covered. Yeah,
I've actually never done a dump of all this stuff that I've learned. I feel like I'm sounding smarter than I really am because I'm just dumping all this stuff.
How long have you been at Sellers Funding? You've done a year or so there, haven't you?
So I was consulting for some other financial technology company before then, and I've been involved in fintech now for about 2 years. I was actually a consultant for Sellers Funding for about 6 months before I took a leadership position there. And that's a little over a year now. I think that was April of 19, and it's wrapping up right now back to a consultancy. So I've got about 2 years in fintech, which is
And I think you've done Ping Pong was before. That's how I met you, and you sponsored some early events of mine, didn't you?
Yeah. I started working with Ping Pong back when I was buddies with them and liked the way that management was being run there. So all right. So there's talk about collateral. Let me tell you my personal opinion. You're going to have a personal opinion about this, Danny, too. The next question is reasons to borrow. When and why would you borrow money? Now, I'm not talking about, long-term strategic investments in a company to buy a bunch of equipment or a 5-year loan on, making another acquisition of other brands. What I'm talking about is just working capital quick loans. The 2 primary reasons that people need to borrow money are for inventory or for immediate growth. Okay. Now, here's what I mean by that. If you need to borrow money for inventory, that's great, especially if you have some history of inventory. If you're restocking inventory, man, as long as the rates are favorable, you almost can't get enough money to buy enough inventory, right? Recycle, because you can predict what the profitability of that is. Don't go too crazy in case, your Amazon account gets shut down.
The bit I was going to say, if you want to break that down even clearer, is I would actually go to the factory first and see to get terms there rather than borrowing money for inventory.
I'm not
that
saying
would be my first
line. There's a lot of ways, especially like getting those terms. But if you are going to borrow money, big suggestion is make sure that you're doing it for one of 2 reasons: inventory, and the other one is immediate growth. And this is what I mean. You don't want to do a 12-month loan to acquire somebody else's brand. You don't want to do a 12-month loan or 6-month loan to go out and sign a lease on a warehouse. You don't want to do that. But if it's for immediate growth, like marketing, like saying, man, Q4's coming up. I know by dabbling with these Facebook ads that I had a good return. Man, I'd like to blow this thing up, but I don't have the cash right now to dump $50,000 into ads this month to increase from my $5,000 budget because I know it's going to take me 60 days to realize that revenue. Like, that's okay. If you know you've got a return on, that's okay. So immediate growth or inventory. Aside from that, never take a loan to pay yourself. Never take a loan to pay staff. Never take a loan to pay the light bill at the warehouse or your warehouse lease or pay your customs. Well, actually, customs you might, because that could be rolled up into your inventory cost, right? But taking money is risky, right? So just make sure that you know exactly why you're doing it. And my suggestion is just for immediate growth or just for inventory, not overhead, not expenses, not to pay yourself a bonus and go on a vacation, right? If you can't pay your overhead with what you have going on right now, figure out why. Is it because all your money is tied up in inventory, which may be? There are people that have a profitable business with no cash flow. If all of your profits are going back to inventory and you're cash poor, that's a great problem to have. Use working capital to pay for your inventory and bring your operational cost of your profit back into running your business, right? Just flip that around. But if you've got no money for inventory and you've got no money for operations, the last thing you want to do is go borrow money because you've got a bigger problem you have to solve first. Right? You're just getting deeper.
Yeah, no, totally agree with that. So first point of call, or credit card. If you need some money to get to see your supplier, the best way to get money out of get terms with your supplier is go and wine and dine them. Take a plan to them. Show them what you're planning to do, have some history with them, and then go and see them face to face and have dinner, stay over there for a few days, meet the family, etc., etc. That's probably the best way to deal with the inventory side. But yeah, like you said, fast growth, then obviously taking cash off the table that's not relevant to, which is only relevant to the growth part. Sybe says, can you go back over the funding of a Ferrari and disappearing to the beach resort? Is there non-beard and cigars mandatory?
There is a joke that we've talked about publicly. There was a guy early on at Sellers Funding that did take a loan, disappeared, and went out and bought a really expensive Porsche.
Right.
The good thing is when you have like the infrastructure and the banking background and like the badass dudes you do at Sellers Funding, you get hunted down. Like they find you. It's not a problem. And there's been some interesting stuff. Cy was saying, or C, I'm sorry, I was talking about a debenture. That's the same thing as essentially a lien in the UK and I think in the EU, same thing.
Yeah.
And he mentioned earlier about my shorts. Look at
that. We're back in the game. We look, are they shorts? Look at that.
Rocking
do you know what
shorts.
I like? It's not the shorts that do it for me. Do you know what does it for me? It's the shoes. Oh, you got flip flops on today. It's when you wear the shorts and you've got like these shoes with tassels on. You fucking kill it for me. That's the bit I love.
It's summer, man. It's summer in Alabama. That's what we.
Yeah.
That's what we got to do. Now let me mention another thing about funding because everybody thinks funding is terrifying. The responsibility of funding should not be terrifying, but it should be taken seriously, right? Because it is a liability. Do consider though your cost of opportunity or your opportunity loss potential if you don't use it in some ways. Now, here's what I mean. If I have a product that's running okay, but I don't have the cash flow to really ramp up my inventory, to ramp up my sales, you're leaving a lot of money on the table, right? And it would be easy to say, hey, if I'm going to make a much more money by being able to bring in this much more inventory or launch 3 more SKUs or spend more money on ads or whatever it is, then you weigh out the cost. Well, my cost of capital over 12 months for this loan is going to cost me $10,000. But because I should sell 50% more, my profit is this, I should profit $50,000 more. Are you going to pay 10 grand in interest for 50 grand more in profits? Of course you are. But another thing people don't consider is timing and stress. All right. Because most e-commerce sellers, this is what they do. They buy 3 months worth of inventory, right? Because that's usually what we can afford. I don't know why it is. That takes 3 months to get here. 30 days to produce, 30 days to ship. By the time it gets into Amazon, it's been 30 days. So by the time that inventory lands, oh crap, I got to order again. And it's this vicious cycle of order, land. And we're always going, I hope I don't out of stock. I hope I don't go to stock. I hope I don't go to stock. I hope I don't go to stock. If everything is profitable, everything is fine, and all you did was said, holy crap, instead of doing a 90-day turnaround, let's do a 6-month turnaround, and you doubled your your order amount. Let's say you wouldn't even sell anymore. Let's say it's a fixed number of units you're going to sell. You doubled your order amount, and you borrowed money, which is going to cost you $4,000 to get 6 months of inventory instead of 3 months of inventory. Will that reduce your stress? And I have to ask myself, because there's operational cost. Every time I order, every time I import, every time I do inspections, right? If you doubled your inventory orders and you just decreased your amount of operations and stress, that will reduce your cost, it'll reduce your stress, and there's value in that. Would I pay $4,000 more in interest or in fees to have less stress? Yeah, I'm at the point in my life now where I would, but that also gives you float and flexibility in case your sales do bump up and you're not always constantly going, holy crap, I'm going to run out. But here's another thing. When you place larger orders, your cost per unit goes down. If I call my factory and say, hey, I want 2,500 units, they'll give me a price. If I say, hey, can I do 5,000 units? I can usually negotiate a discount. So by going from 5,000 units to 5,000 from 2,500, what if I can save 10 or 12 or 15% per unit on my order? And then shipping, instead of a half a container, I've got a full container, right? So my cost per CBM goes down as I increase my shipment. And then instead of 2 shipments of 20 CBM each with 2 import declarations, 2 sets of paperwork, 2 clearing costs, 2 truckings, all that stuff, I've reduced that. I've done this on paper pretty frequently. And if we're going from a half a container to a full container, and a lot of similar size products, 2,500 to 5,000 units, our cost for the product landed can drop by as much as 35%. Now, let me ask you this. If you were ordering $50,000 worth of inventory and you could save 35% by doubling your order, so going from 3 months to 9 months, and it only cost you an additional and you had to borrow the money for
What
the
do you mean 3
second
months?
half of
You
the
double your
order,
order book 3 months to 9 months. What do you mean by that? Because
or 3 months to 6 months. I mean,
six. Yeah. Sorry, go on.
3
Yeah,
to 6.
Yeah.
Is it worth the interest? For the less headaches and the more flexibility, yes. But then if you also consider the decrease in your cost of product, a lot of times the savings of your product cost is even more than the additional amount that you'd have to pay for interest or fees for the loans. And when you really break this thing out on spreadsheets, you go, holy crap, I can't afford not to borrow money as long as it's responsible money, as long as it's affordable money. But stretch this stuff out, because a lot of people forget that. A lot of people forget that, like, hey, if instead of buying, I can pay cash for 5,000 units, but if I borrow money to get 15,000 units, my cost for inventory goes down by 15%. I'm not going to run out of stock as fast, and I can afford to push harder, and because I won't have as many reorders to do for smaller cycles. So do your math and remember that sometimes that interest, which I would think about, expense, is actually an investment which will help us make more money later.
Cool. Right, we've done 50 minutes on funding. I didn't think it would be possible. I'm not surprised. Right, should we wrap it here? I think we pretty much covered it.
Yeah, unless there's any last questions, but I think that was good.
There's Cybe says, joking aside, there's such a crucial topic. Every business needs funding at some point. This leads to cash flow forecasting being absolutely critical. Indeed it is. Tim, what's the best way people can reach you?
Hit me on my Facebook group, Private Label Legion. You can search that. I'm partners with Norm Ferrara on that. We run that together.
You've been launching some new bits there. What's been going on there? The fucking images are mind-blowing, where they're superimposing. Now, you normally come off worse, right? You look like
I'm always the sidekick, or I'm always the Oompa Loompa, or I'm always the... Yeah. I don't know.
What have you done? Just because I'd never remember the names, but they crack me up as I see them go past on Facebook. What have they done to you? Tell them what they've done.
Oh, they made me an Oompa Loompa from Willy Wonka, and of course, Norm was Willy Wonka. I was the second place guy in the Talladega Nights, and of course, Ricky Bobby was Norm. They've done all sorts. And look, I hear rumors because I never know what those images are going to be. And every Thursday, it drops, and I go, holy crap, here it is again. But they've talked about Shrek and Donkey coming up next, and I was like, thank God, even if I'm Donkey, Norm is still Shrek. Like, it's still a little bit of parody. We've done Step Brothers. Like, there's been so many, and the team started doing it as a joke, but now we're putting it in our Private Label Legion newsletter. So shameless plug, if you guys don't mind, go to privatelabellegion.com, scroll down to the bottom and sign up for our newsletter. And every week we send out a newsletter with all of our new content. Just mountains of tips. We write up all sorts of cool stuff in the industry, and every week we get the new picture that's released of me and Norm, which is pretty hilarious.
Even if it's not for the newsletter, you got to sign up for the images, because your graphic artist done a really good job. Because normally,
have you ever met my graphic artist?
No, I've got a really great one in.
Hey, Eric, come here.
He's here.
Let's see if he's never actually been on a live video. I'm about to.
Let's bring him on then. Let's give him some love.
Unveil.
Yeah.
You coming? All right, come here. So, Eric, I'm putting you on Danny McMillan's podcast. How many people watch this typically?
We get between 45 and 50,000 downloads a month across the board.
45 and 50,000. Eric, we're introducing, this is Eric Fullerton, our graphic designer. Danny was just talking about these amazing weekly pictures of me and Norm. And he said, your graphic artist is amazing. I said, well, we're going to introduce the world to Eric Fullerton. Here he is. Eric, will you give us a hint of the picture that you're dropping tomorrow, or is that still top secret lock and key?
You're finally not going to be a goober.
I'm finally not going to be the goober. This is amazing. But you notice he didn't say what it is. So, anyways, we'll have to wait and see till tomorrow. But thank you, Eric. Danny wanted to recognize you and tell you.
Give you a shout. Hopefully, your inbox will get firebombed now with people with requests. Let's see.
That's it. People make suggestions all the time, and sometimes I try to delete them before Eric sees because they're horrible suggestions.
Well, because the shit stick is hit. You get hit with the shit stick, so you're always on the receiving end. Right? Should we roll out of here now? Let everyone go back add their piece and get to run their businesses, and maybe go and grab some funding, but not at 164% APR over the year. Tim, thank you for joining. Email address, anything? Let's quickly cover that again before we go.
Yeah. If you have any questions about funding, email me at my Sellers Funding. It's just tim@sellersfunding.com. Anything else, just join the Facebook group, Private Label Legion, make a message in there, and we keep track of that. And that's the best way to get in touch with me.
Superb. Guys, Sharon Evan be back here in the chair tomorrow. Isabella back, of course, on Monday. I'll be back here Tuesday and Wednesday. Take care of yourself and your family. Much love. And I look forward to seeing you again soon.